I'm glad I get to be here when the week was a strong week. What a change it's been since the last several weeks. But boy, what a bounce we saw this past week.
Oh, it certainly was. The S&P was up a little over 2%. The NASDAQ up almost 5%. Small caps up 2.6%. And we actually saw the 10-year yield bounce 21 basis points to 3.09 on much stronger economic data than many people would have expected.
Yeah, just look at that, 3% treasuries, right? So you almost have to start to think about that in terms of, where can we allocate relatively low risk money, and all of a sudden treasury yields become attractive. Of course, that is part of the equation of people thinking about how to reallocate money, and it has impact kind of throughout the spectrum.
Right. I mean, really, for seniors, if you think about it, for the first time, a 3% yield on a CD is becoming fairly commonplace. And, during those years of financial repression, it was really hard to generate any kind of yield at all with cash reserves.
Yeah, to a large extent, we always talked about that. What the Fed had to do to drive interest rates to zero really hurt the saver, not the investor. The saver put money into savings is the way you think about that. And so that's CDs, money markets, those sorts of things. And what it did was it really boosted risk assets. So that's the stock market. And now, of course, we're unwinding all of that excess liquidity. And so that is what is driving all the market anxiety. And we need to look at that from the perspective of where do we go forward from here? Things we watch, are like the jobs data that we saw this past week, so we can get an indication of how is the economy weathering the tightening that we're seeing in monetary policy right now.
Yeah, and I think a real takeaway that I've kind of generated in my own mind the last several weeks is no one is really interested in hearing good news right now. Everybody wants to be negative about the recession fears, stagflation, the price of gasoline, the Russia-Ukraine war, now an assassination of the former prime minister of Japan. I mean, there are any number of negative data points one can follow. And that's why that consumer confidence survey got so low. And historically, when you have that low a level of consumer confidence, almost a contrary signal, you really need to look at the world with a glass as half full approach, not half empty.
You do. And I think if you look back historically, it's more common that you're going to see sort of that peak negative news cycle occur after the market has already bottomed out. And to a certain degree, there's good news starting to, show itself. But, the news cycle is focused on the negative because you're right. Everybody gets kind of into that zone where all you want to hear is the negative because it becomes sort of self-fulfilling to an extent.
Yeah. Working on that quarterly letter mark that we send to all our clients, Todd and I've talked a lot about approximating a bottom. And, one of the ways you can approach that is to take a look and say, okay, what is the future path of returns likely to be? Better than average or worse than average? Typically, if you avoid a recession, the sharpest decline you see on average is about 25%, which essentially is what the S&P did at one point on the lows in the middle of June. Small caps even more, and NASDAQ even more than that. So, at this point, if we can avoid a recession, if we can just kind of meander through for the next couple of months as inflation peaks, commodity prices continue to roll over, there could be some really great buying opportunities presenting themselves in fairly short order.
And then isn't that what you would say is kind of the tug of war that's driving some of the volatility we're seeing in the market, is people trying to digest that very risk of will we or will we not be able to avoid this recession? And if we do, by the way it looks like it's shaping up right now is it would be likely like one of the softest, gentlest recessions we've ever experienced.
There's an old saying that price is truth. And those that waste time trying to forecast the economy are doing that, wasting time. In fact, Peter Lynch, the former Magellan fund manager, used to say if an analyst supported his recommendation on a stock by citing their future expectations for the economy, he'd kick them out of their office.
Yeah, that's good insight, actually. And, when I sit and talk with clients, which is my job, we get to share that idea of thinking about what you own in terms of the quality of the investments, not in terms of what the economy is doing.